And now to our market monitor, who has names of stocks she says could grow 15% over the next year or so and also provide some nice dividend income. And get this, the last time she was on in July, she recommended the following stocks, and they have all risen double digits, some by as much as 58%. Mariann Montagne, portfolio manager at Gradient Investments. Mariann, welcome. Let's say we do it again, just like last time, all right?
I'm a tough act to follow, Tyler.
You are a tough act. Well, follow yourself here. Let's start with British American Tobacco. Why do you like it?
Right. So this is a company that is acquiring Reynolds American, and they can leverage off of Reynolds' portfolio around the world with products like Newport and the vapor e-cigarettes. It yields 3.5%. It's valued far lower than any other consumer staple stock, and particularly the other tobaccos.
Next on the list, Invesco. You say it's not like some of the other banks that are out there. Why?
Yeah, when you look at the financial sectors, the banks have done extremely well since the election. And here's a financials name that's not a bank. It's an asset manager. And perhaps you know the exchange-traded funds that they offer, power shares. So with the gains in the stock market, they gain assets under management, and their fees grow. And along with the explosion in exchange-traded funds, we expect them to continue to do very well. Again, a nice dividend yield, about 3.2%, and a multiple of 12, where the market is more like 17 times.
You know, the food business, Mariann, much in the news today with that proposed merger of Kraft and Unilever. Your third pick, probably benefiting one way or another from these discussions, is Nestlé. Why do you like it?
Well, Nestlé offers a 3.5% yield. So again, we're looking toward 15% total return from these three names over the next year or so. So that's a nice start with 3.5% yield. But their focus has been on wellness, and for the first time in about 100 years, they've actually gone outside their own ranks to bring in a new CEO who happens to be from the healthcare side of things. So we expect a change in their portfolio toward faster-growing wellness-type products, and those happen to be higher-margin products. At the same time, they've embarked on a nice, substantial 3-year cost reduction program. So I think, being where they are, global, around the world, in Europe, it's already, I think they stand a better chance at cutting costs than Unilever might when they encounter, or when 3G encounters the European commissions and they try to take out the headcount. I think they're up for a big battle in Europe.
Very quickly, do you like the U.S. market, or it seems as though you're favoring the international market maybe a little bit more?
Yeah, the international market has underperformed the U.S. stock market on a 1-year, 3-year, 5-year, and 10-year basis. So we think valuations are better overseas than they are in the U.S. We think the U.S. is fairly valued, not fully valued, still upside in the U.S., but more upside overseas.
All right, Mariann, thank you again for being with us, and congratulations on your very good picks last time. May you do it again.
Thank you.
Mariann Montagne with Gradient Investments.